Welcome back to Capital Mindset, everyone. Today, we're going to be talking about another controversial stock, and this one was heavily requested, United Health Group. So first, let's acknowledge very controversial stock. A lot of people have mixed opinions on it. I want to say, okay, I acknowledge that you feel that way. Today is going to be a video talking about the investment proposition, and we're going to be going over it from that point of view. So that being said, let's get right into it. So over the past 5 years, this stock has returned 3.64%, excluding dividends. And let's talk about the start of the controversy, which is, of course, the unfortunate and tragic assassination of Brian Thompson, who was the CEO of United Healthcare, a subsidiary of United Health Group. Okay, so not to be confused, it's not the CEO of the overall business. So passing that, they got into a lot of trouble with the DOJ, or it was brought up in a Wall Street Journal article. Of course, by the way, that Wall Street Journal article is reporting on stuff that's actually fairly old. It was resurfacing for whatever reason. I'm not going to get into that. And the CEO at the time just recently resigned or stepped down. And the older CEO, the chairman, came back as CEO. He was the one who actually built a lot of what United Health is today. So he's this rock star CEO coming back, does a major insider buy orders along with some of the other insiders. And this brings a lot of attention. The stock had an intraday drop to, I think it was about 250 or 270, and now rallied all the way back above 300. It's consolidating here. If you're a technicals guy, it's been consolidating for a while. It shouldn't really, this is kind of jumping ahead of the discussion, but it shouldn't really move until we get the next catalyst, which we'll get into later in this video. So let's talk a little bit about the structure of health insurance. A lot of people may not know some of the nuances in Capital Mindset, which again is in the description below. If you're curious, I'm joining the Capital Mindset Club. I do portfolio updates, weekly calls, etc. We did a discussion, roughly 4 hours, with healthcare professionals from both sides, from both the care side and also the insurance side. And it was very insightful. What you came out of it was it's extremely nuanced. A lot of your preconceived notions about how the United States healthcare system works, you might go into that discussion and come out of it with a totally different mindset. At the very least, you'll be like, wow, it's actually way more complicated than I thought. I think that's the number one takeaway that at least I took away from that 4 hour conversation. And what I also kind of figured is, depending on potentially the practice you're involved with and how you're actually interacting with United Health. So again, depending on your practice, you might have completely different experiences, might be excellent experiences. If you're dealing it from the Medicare Advantage side, or if you're just dealing it from the corporate side, right? And when I say corporate side, the corporate plans, which United Healthcare is actually one of the largest involved in the corporate healthcare side. So like employee benefit plans. And that was actually fairly interesting. Again, I learn a lot from the community with all the different expertise that kind of come together, and I want to have as many conversations as I can, because I'm constantly learning from others, a little bit, from here, a little bit from there, and trying to meld it into a thesis, an investment thesis, or an investment opportunity. So with United Health here, you may also not know about the 80-20 rule, and that goes for all healthcare insurance. Okay, what is the 80-20 rule? Well, the 80-20 rule simply states that roughly 80%, I think actually not roughly, 80% of premiums collected must be paid out to the claims. And so this is an effective cap on profitability. No other kind of insurance has this effective rule. And so a lot of people point at that and say, hey, well, this is called insurance, but it's not really insurance. And this cap was actually put into effect under the Affordable Care Act. And since then, there's been a tremendous amount of consolidation in health insurance. So if you actually look at the stats as to what we used to have in the United States as far as the variety of healthcare insurance providers versus what we have now, you can see massive consolidation over time. And I think it has something to do with the difficulty of maintaining profitability. So we'll kind of get into what the profits actually look like. And this actually comes from our sponsor, which again, I don't get sponsored unless I actually use the product. And I use this product often because it has great visualizations, and for showing it to you guys, it's perfect. So the link is in the description below if you wanting to support the channel in some way and you want to create charts just like this. So all I have here is all of the major health insurance providers: United, Elevance, Cigna, Humana. I didn't include Aetna, which is under CVS, just because it has that retail division. And I want to emphasize one thing to you guys here. They're not apples to apples comparison. What I mean by that? Well, United and Elevance have different focuses. They have different niches that they focus on. So While there are basically in the same business lines, they don't have the same strategies or focus points. So their margins being different is to be expected. And so it's not something to say that Elevance is a terrible company because their profit margins are significantly lower than United Health. United Health has a huge focus in Optum, which does affect those profit margins at the end of the day, because in the healthcare side, the provider side, you don't have those same profit caps, right? And by the way, if you're curious about what the profit margins look like in the provider side, they're also quite low relative to other businesses we might look at. So from the investor standpoint, and I know that sounds crazy, right? You're saying like, wow, they don't have high profits, right? Because from the investing standpoint, when we look at a bunch of other different kinds of companies, oftentimes we'll see profit margins in excess of 10%, even approaching 20%, and those are considered good businesses. Here, we're looking at profit margins in the single digits, something akin to like a retailer almost. And what that implies is if there's any room for error, it does not exist here at all. So they're constantly weighing the risk profile of the policy, and the profitability is dependent on their measures of this risk. If there's any blow up there, well, now you have a problem. You can quickly go from profitable to unprofitable. And while other insurance don't have this issue, so PNC, PMI, et cetera, they don't have the same issue. So they're rewarded consistently for doing appropriate measures of risk. Health insurance, for that point, people argue it's a utility, and really it's moving money from point A to point B. And again, you can see the consolidation of these profit margins funneling through after the Affordable Care Act. But I think I like that argument, saying that it's become more of a utility, and all they're doing is they're just like collecting a toll fee from these massive systems. So United Health is collecting, let's say, a 6% toll on the high side of the total system. So it's not like they're making the crazy money hand over fist. A lot of people think that, but in reality, it's not correct. And also, when you look at the provider side, I think the margins, you can see like HCA has profit margins in the 7. It's usually high single digits. So it's nothing crazy, but you think a lot of people have this perception that the profit margins are probably like 55% or something crazy like that. But it's really a volume game. So a lot of these businesses, that's all it is. It's a volume game. How much volume can you put through your system? And because it's a volume game, it benefits you when you're larger. And so we saw this consolidation. So all that to be said, this is kind of why we saw massive consolidation in the industry. So it makes sense. Now, a lot of investors look at that and say, well, I don't like all this drama around this for a business that at the end of the day can't really be that profitable. So I'll avoid. And that's actually a perfectly fair argument. You might not like this industry just for that reason. And I will not fault you for that. There's so many investments out there, so many different opportunities, that just on that reason, Xing this out, perfectly fine, perfectly valid. I don't think you're dumb or anything like that for this. So let's get into a little bit about the drama around United Health. So when United Health was falling, of course, we saw a lot of people come out with different posts. This one from this individual here, and he puts out sometimes a lot of negative stuff. I like to do this post here and there. It's like, oh, another nice setup. With Tom Lee over here on April 7th, another nice setup. So if you guys aren't following me on Twitter, follow me on Twitter. A little bit of a shout out. But all in all, there was a bit of a mix. I think today a lot of retail is quite bullish, which makes me not nervous, but it doesn't give me the spark of confidence that I like to see when it's like the contrarian side, because I do have that contrarian bone in me sometimes. That's like, a lot of these certain kinds of contra indicators like it. Is it really that good of an opportunity? Which we'll get into right now. Let's get right into the valuation. And so I pretty much came with this rough sketch of what I think the value is. And I want to clarify, there is no negative scenario because I view it as somewhat of a binary outcome. What do I mean by that? Well, I view that if nothing changes in government, then this company, and this goes for the other health insurers, this company should have a steady state upward trajectory in earnings for the foreseeable future. However, if there is something that changes, that's the only way I see where earnings start to drop. And recall earlier in this video when I said there's a catalyst, or it's not going to move until there's a catalyst. Well, there's a catalyst coming right on the horizon. So this is why I wanted to get out this video before July. And so as you're watching this is being recorded June 29th, 2025. this might be old news by that point, but they're going to release guidance, and I believe it's going to be somewhere in the low 20s EPS for 2025. And then, as they've already stated, they think that they're going to continue to grow next year and beyond. So what that growth is going to look like, I think it's going to be in the low teens to 10%. So I assigned those the highest percent probability, their highest higher weighting. And all this culminates into a weighted average price or fair value of about $404.83, which is about $100 or about 30% upside from today's price. Now, this does imply, I think, a decent margin of safety at today's price, probably a very high or optimal margin of safety, roughly in the $220 mark when I looked at some of the most conservative scenarios when I was modeling this out. But I don't think those are very high probabilities, because again, I view this more as like, okay, it's sort of a binary, if or if not, there's something that breaks. So I'm not including the breaking scenarios, because if it's going to break, you might as well take the loss, sell out, and move on to something else. Now, that being said, when I get to allocation, which I'll just be fully clear here, I have some shares and I have sold puts, so short puts. All that is a small fraction of my overall net worth. Why? Because it being a binary outcome, I respect that risk at the end of the day, while acknowledging that it could turn out really well. And so I want some involvement, but I want measured involvement. I know someone who has nearly 100% of their portfolio in this stock, and I wish them all the success. And I think it's going to do well. I genuinely do. I think 5 years from now, we're going to look back and say, oh, United Health was a obvious buy, right? But I'm respecting the binary risk. And so I want to have measured exposure, while I also am really attracted to other opportunities out there in the market that I think have, more or same, if not more upside for more understandable risk on my part, right? And because at the end of the day, that's one of the more important things that we want to be aware of or cognizant of. You want to take on risks you understand, rather than taking on risks you may not understand. And so in this case, I don't have this crystal ball to figure out what politics are going to do in the future. I have a hunch that it's not going to change too much. I strongly believe that, but I want to, measure against me being wrong, or not bet against, but hedge against me being wrong, and not take an outsized position. So unfortunately, for that reason, I can't really make this one a core position at this moment in time. And when I, to give you guys specific percentages, I probably would put a max percentage for myself at around 3%. That'd be probably teetering up. I wouldn't sell or liquidate my position if it got above that. I don't like to punish my winners. But in terms of initial capital, I can't really justify myself putting more than that in terms of total exposure. So you guys can let me know down in the comment section below how you guys feel about United Health. And again, if you're interested in joining the Capital Mindset Club, checking out my portfolio updates, as well as the other analysts, again, that link is in the description below, and joining a community of investors and, sharing ideas. All right, with that being said, thank you guys so much for joining us today, and I'll be seeing you guys on the next video.